The AI boom is here, and it's bigger than the dot-com era. I'm Ricky Flores of the Margot and Ricky team with Sotheby's International Realty, and in today's video, I'll be talking about, you guessed it, AI. The next wave of wealth creation isn't coming, it's already underway. Artificial intelligence has rapidly become the most capitalized and fastest scaling sector in modern history, with companies reaching extraordinary valuations before even entering public markets. Let's consider where things stand today. OpenAI is valued in the range of $800 billion. Anthropic has climbed to roughly $300 to $400 billion. Databricks, Scale AI, and Perplexity AI are all commanding valuations from $10 billion to $100 billion. Now, at the same time, the IPO pipeline is forming, with OpenAI leading the charge and widely expected to be happening soon. Anthropic is another IPO candidate, with xAI and the broader ecosystem being mentioned as well. This isn't just another tech cycle, it's a large-scale liquidity event in the making. This has echoes of the dot-com boom, but it feels more supercharged. To understand what happens next, it helps to revisit the dot-com bubble. Between 1995 and 2000, tech IPOs created sudden, massive liquidity. Stock compensation minted a new class of millionaires almost overnight, and the Bay Area housing market saw a sharp price acceleration driven by equity wealth. However, today's environment is fundamentally different. These AI companies are scaling faster, raising significantly larger rounds and achieving higher valuations before IPO. Their capital is concentrating earlier and at a magnitude the dot-com era never reached. However, this transformation comes with real friction. Workforce displacement is already underway. Across the tech sector, companies are actively reallocating resources toward AI, often at the expense of headcount. Tens of thousands of layoffs have already occurred in 2025 and 2026. Roles in operations, support, and even engineering are being consolidated or eliminated. Companies are shifting from large teams to smaller, highly leveraged AI-driven organizations. This is not purely cyclical downsizing, it's structural. Capital is moving from labor to computing, infrastructure, models, data, from broad hiring to efficiency and automation, from growth to output per employee. In many cases, companies are restructuring ahead of full AI capability, not after it. This creates a dynamic we've seen before: short-term disruption for long-term wealth creation. During the dot-com era, thousands of jobs were lost when companies failed or consolidated, but the companies that survived and the employees who held equity generated extraordinary wealth that flowed directly into real estate. That same pattern is emerging again, only this time the companies are larger, the capital is deeper, and the potential liquidity events are exponentially bigger. What does this mean for Bay Area real estate? Well, when liquidity hits its scale, it doesn't stay in the market. It moves into hard assets, and historically, residential real estate in the Bay Area has been one of the primary beneficiaries of tech-driven wealth cycles. We're already seeing early indicators. High-income AI professionals are entering the market pre-IPO. There is secondary liquidity from private shares and increased demand in core markets like Palo Alto, Menlo Park, Atherton, and the broader Peninsula. But the demand curve is evolving. In the near term, layoffs and uncertainty may temporarily soften portions of the buyer pool. Mid to long term, wealth will concentrate among a smaller group of highly capitalized buyers, those tied directly to these successful AI companies. The result of all this? Well, fewer buyers, but significantly more purchasing power per buyer. In markets like this, positioning becomes critical. At Sotheby's International Realty, Margot and I are focused on the Bay Area's most supply-constrained, high-demand submarkets, precisely where IPO-driven demand historically concentrates. Our approach centers on access to off-markets and pre-market inventory, proximity to AI and venture capital hubs, with advisory tailored to pre-IPO and post-liquidity clients. Because today's buyers aren't just purchasing homes, they're converting equity into tangible assets while hedging against volatility by establishing long-term positions in globally scarce markets. The bottom line here is the AI boom is already reshaping the economic landscape. It's created displacement in the workforce, an unfortunate downside. However, for those working in the space, they will have benefited significantly. The AI boom has also seen capital concentrated at unprecedented levels, while also setting the stage for one of the largest wealth creation cycles in history. If the dot-com era transformed Silicon Valley real estate, the AI era is poised to redefine it entirely. For buyers, sellers, and investors alike, the opportunity isn't just in reacting to the market, it's in positioning ahead of the liquidity. The AI boom will create wealth, but timing will determine who captures it. Margot and I are already working with clients to get ahead of the next wave. The question isn't if the market moves, it's whether you're positioned before it does.